Good afternoon and welcome to BizTech's Asian Midday Market Watch. David Kuo, founder of the Smart Investor in Singapore, is our guest today. David, good afternoon.
Good afternoon, Brian. Yes, Salamat Tenggahari.
Now, David, I'm going to come back to you after we take a look at cryptocurrencies and regional stock markets. Now, we've got Bitcoin, which is at 44,021. It's up 2.55%. Now, looking at regional stock markets, and we'll take a look at that right now, we have the KLSC, which is at 1,600.91. It's up 0.12%. Shanghai is at 3,230.21. It's down 0.6%. The ASX All Ordinaries is at 7,700.1. It's up 0.41%. The Nikkei is at 28,131.5. It's up 0.08%. The Hang Seng is at 21,578. It's down 1.68%. And rounding up the numbers, we've got the Kospi, which is at 2,734.9. It's up 0.19%. Now, David, what's your view on market performance this morning?
Well, if you have a look at what happened in Wall Street last night, the Dow was up about 300 odd points, which was quite a good performance. You would have thought that there would be some follow-through buying over here in Asia, but I think Asian traders, Asian investors were having a look at the futures market in America, and they're saying that it seems to be indicating pretty flat opening for Wall Street. So maybe they're just sort of sitting on their hands at the moment. And let's not also forget, Brian, that today is Friday, right? Which means that if you buy anything today, you've got to wait 2 days until Monday to find out what has been happening in the world. And if something terrible happens on Saturday or Sunday, there's nothing you can do about it because the markets are closed and you'll have to wait until Monday. So I think it's a bit of caution over there, Brian.
Now, speaking about wondering about what's happening in the world, David, I mean, for normal investors right now, the war in the Ukraine essentially looks like it's going to go on for a long time. Inflation looks like it's going to be persistent. Central banks look like they're kind of behind the curve. So essentially, as investors, there's a lot of uncertainty out there, and we are going to go into a period of rising prices. So what sort of businesses should we be looking at hunting in order to put our money in?
Okay, I mean, you paint a pretty bleak picture, Brian, and I think the picture is very, very confusing for a lot of people. One thing that you probably didn't mention or didn't want to mention is this our word called recession. I mean, there is also
and stagflation.
I know. There is also a possibility that the world could go into some kind of recession as a result of the high prices, which the central banks have to try and overcome by raising interest rates. And the last thing we want to do at the moment is to raise interest rates because we've only just started to recover from the pandemic. So just when we thought it was actually safe to come out, suddenly we get high prices caused by, initially it was caused by supply constraints and supply disruptions. And people said that would eventually sort of work itself out. But then we have this war in Ukraine that's pushing up commodity prices, it's pushing up oil prices, and it looks pretty much, and you're quite right, Brian, that this inflation is going to be fairly persistent. So the central banks need to do something. You cannot have the Fed fund rate at 0.5% when inflation in the US is running at 7%. I've always said that the interest rates that central banks levy has to be higher than the inflation rate if you're going to keep a lid on inflation. But at the moment, I think Jerome Powell is just hoping. That's a terrible thing for any central banker to hope that things will be okay. He's hoping that inflation will come down. He's hoping that the economy won't go into recession. He's hoping that unemployment won't rise. But if we do get those three things, high inflation, slowing down in the economy, and rising unemployment, we get what you just said, Brian, stagflation. So what do we do? Well, in my case, Brian, I'm looking for companies that produce things that are essential, things that people can't do without. And also those companies that, if they were to experience higher prices, can in some way move those higher prices onto consumers in order to protect their own profit margin. So what kind of companies are these, Brian? Well, just look at the things that you do on a daily basis. You have a shower, you wash your hair, right? So look for those companies that make things like shampoos and soaps. You wash your clothes every day. Just because prices are high doesn't mean you're not going to wash your clothes anymore. At least I hope it doesn't happen, because otherwise catching public transport is not going to be very pleasant. So those are the companies that you need to look at. And if you look at the stock market, there are lots of companies that have said they are able to pass on those price increases, Brian.
And I suppose one of the things that the methods that they use in order to pass prices is to make very small incremental price increases. So as we learned in Consumer Behavior 101, below the just noticeable difference threshold.
Well, some will try and do that. Some will go for shrinkage. In other words, they will shrink the size of the product that they are supplying you in the hope that you will continue to buy. If a company were to increase price, say 20%, what are you going to do? I mean, you could feel it in some cases, in which case you would say, I don't want to buy this product anymore. The other way they can do it is to reduce the size by 20%. So put a few less peanuts in a packet or something, and you will still be able to buy that product, but you won't have to fork out too much more for it. Or they may go for some kind of mix where they reduce the amount by 10%, increase the price by 10%, and then they'll be able to sort of pass on that price increase to you. But look for companies that have pricing power. If you go for those companies, you won't go too far wrong.
Now, I think Starbucks is one of those names that has pricing power. But interestingly enough, I think even though it's not so obvious, I think Apple has an element of pricing power as well.
Oh, absolutely, yeah. Well, Apple is trying something a bit different. I mean, there was a report that came out yesterday suggesting that Apple are going to try and not reduce the price of their products, but spread the cost of their products over a longer period. So if you want to buy that latest iPhone, you're still going to have to pay that price, but you won't have to suffer the pain of forking out $1,000 or more for that iPhone, but you can spread that payment over a longer period. So you could actually sort of spread that payment over 12 months.
And so that's a new revenue stream for them, because there'll be financing involved, and there'll be also basically replacement cycles that are enforced on you. So that will be really quite interesting to watch. So people won't hold on to their phones as long as they previously did.
Yeah, it's called designed obsolescence, Brian, and we know how it works. You buy a laptop, you think it's great. After about 2 or 3 years, you suddenly find the software that you want to install and it doesn't work anymore, or your memory isn't big enough, or your chips aren't fast enough, and you can't do it. And then you're going to have to go out and buy another laptop. So it's designed obsolescence, and Apple are the past masters at designed obsolescence. By the way, I still have the original iPhone 1, I think. At that time, it wasn't even called the iPhone 1, but it's absolutely...
And does it still work?
No, it doesn't.
Now, David, on to something else, which and a very interesting article that you wrote in Channel News Asia about Grab.
Yeah.
And talk us through some of the key talking points or points that you've raised in that commentary.
Okay, right. I'll try and be as brief as possible. But Grab was meant to be the shining light on the tech industry, the unicorn industry over here in Southeast Asia. And instead of listing here in Singapore, it went through that SPAC process, and it decided to list over in the US. It raised about sort of $4 or $5 billion US, which is great. And so it's got all this firepower. Now, what is it going to do with all of this money? First of all, we had the pandemic, and we have inflationary problems. We have all kinds of problems that Grab's businesses are exposed to. So it's been using this money in order to try and keep its customers sweet. It's trying to keep its delivery drivers, its normal drivers. It's trying to keep everybody sweet by buying loyalty. It's using the money through giveaways, through coupons, all sorts of things in order to buy loyalty. And when you have a look at that, Brian, it's got no profits. It's got plenty of...
And David, in your article, and I'm going to read this out verbatim. So you pointed this out. After accounting for generous incentives, revenue actually fell 44% to 122 million US dollars in the fourth quarter compared to the previous year.
Yeah.
Delivery, where incentives were most pronounced, only booked 1 million US in revenue, down
Yeah.
98% from the previous year. Now, that, as an investor, that rings alarm bells.
Yeah, I know, but the point is, Grab says it's got this thing called the super app. If I hear anybody mention super app one more time, I'm going to pull my hair out, right? They seem to think that the super app is some kind of universal panacea that is going to solve all of their problems. And they're trying to get things to stick to the super app. They're saying that if we keep our aunties and uncles happy using our delivery process, they will then maybe consider using our fintech services that we have. And they're trying to sort of keep people locked into their ecosystem. But how long can that go on for, Brian? I mean, let's not forget that they only raised about $4 or $5 billion. And if they keep on throwing money at this, the analogy I used is a bit like throwing spaghetti. A lot of the old chefs in the old days used to test spaghetti by throwing them against the
Right
wall
against the wall.
to see if it sticks, right?
Yeah.
To see if it sticks. If it sticks, it means that the spaghetti is done. Now, Grab seems to be going through this process right now. They're throwing money at all their various parts just to see which ones work. Eventually, they could run out of cash, and that is the big danger.
And the net cash position now, I mean, at point of reporting was only 6.8 billion. So seems like a lot of money, except that on the present trajectory of spending, you are basically only looking at just over 2 years of cash.
Yep. And then what happens after that?
Yep, absolutely. And I suspect that some rationalization is probably just around the corner.
It could be. And I feel sorry for those investors that bought at the IPO. I think they're down about 80% at the moment, which is not a very pleasant feeling. Yeah.
The peak share price for Grab was $17.15. The share price overnight was $3.63.
Yeah.
Just to put everything in its perspective.
Yeah. Okay. There's a lesson there for everybody. If you're going to go, right, if you're going to believe in the SPAC, be prepared to bear some pain, because who runs off with the money when you invest in a SPAC? Ask yourself that. Yeah.
Yeah. David, thank you very much for your insights, and thank you for taking your time to come on the show.
You're welcome. Thank you.
Now, we've been speaking to David Kuo, founder of The Smart Investor, coming out of Singapore on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Please check out our website, www.biztech.asia, as well as our social media platforms. Please like and subscribe to our various platforms as well. Thank you very much for tuning in.